first principles, there's too much debt. And we can't manage it, and we don't have the money to pay for the interest, let alone actually pay off any of the debt. And that's the dirty truth. And we don't raise enough taxes because economic growth is trending lower over time due to demographics. So you don't have the money to pay the interest. You can't pay off the debt. So you're in this trap where you have to, everything is about managing the debt.
Right.
And from 2008 onwards, the number of these ridiculous parts of the plumbing system that got invented to stop that bit broke, and then that bit broke, and that bit broke. It's because the whole bloody thing is broken, and we're just trying to tape it up. Which is why, in the end, I saw this coming back from 2008, 2012, is why I got into crypto. I got into crypto for this.
Government bonds, often overshadowed by stocks, play a pivotal role in the financial system. Last year, U.S. Treasuries faced a tough time, mirroring stocks and other investments, due to the Federal Reserve's interest rate hikes aimed at combating inflation. The Bloomberg Barclays U.S. Aggregate Bond Index, a benchmark akin to the S&P 500 for bonds, experienced a nearly 15% drop, marking its most significant decline since its inception in 1976. In contrast, stocks have shown a strong rebound this year, with the Nasdaq climbing over 30%. However, the bond market has been slower to recover. This trend stems largely from investor expectations that inflation will persist above the Fed's target, necessitating the maintenance of high interest rates. The implications of a weakened bond market are far-reaching, affecting various interest rates. Elevated credit card, mortgage, and auto loan rates, as explained by Stephen Juneau, senior U.S. economist at Bank of America, could diminish consumers' spending capacity, ultimately leading to a broader economic slowdown and potential payment delinquencies. Joining the discussion, macro guru and expert Raoul explores themes including bond yields, inflation indicators, rate cuts, and his outlook on the global economy.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
And I've spent a long time actually thinking about this. I say that flippantly, but actually I spent a long time thinking about this because all of the business cycle indicators, all of the inflation, forward-looking inflation indicators, all of the unemployment indicators are all suggesting the bond yield should come down and that inflation continues to fall, both at core level and at headline level, and that unemployment continues to slowly grind higher. So why are bonds not suggesting that? You know, while equity markets already started pricing in the fact that there's more liquidity in the system. And I think it's down to supply. I think it's really down to supply because the Treasury has to issue a lot of bonds to finance both the interest payments from the bonds that are coming from maturity, set at higher rates, and the new borrowings that they have. The bond market is already trying to absorb a bunch of this stuff, and there's just not the ability to absorb it all. So supply is pushing yields higher for the time being as the Treasury rebuilds its coffers. The issue is there's about $6 trillion of debt maturing between now and the end of the year. What the Treasury have been doing is issuing short-dated notes generally to finance it. The reason they're doing that is they don't want to lock in 5% rates because before you know it, the budget deficit explodes high.
Right.
So there's a game that I think they're playing here is the Federal Reserve have to, and all the central banks doing the same game because I think they're all in cohorts, part of this everything code theory. They are going to try and hold this rates up as long as possible to make sure inflation undershoots. Because when it undershoots, they have the cover to cut rates back down to trend rate of GDP growth, which is like 1.75%. This issue of the Fed staying as long as possible because they really want to have the complete green light to do what they want, crush inflation expectations. The market knows rates are too high, obviously. So they're saying, listen, you can't do this for long.
Right.
And the Fed keeps shunting them along. And this is the higher for longer argument, which has been pretty accurate. The question is how fast does it reverse? And the market never usually forecasts this right. Normally, once they do cut, they cut faster than the SOFR curve or the Eurodollar curve used to in the past. So, you know, we have to wait and see. But it's all to play for in Q4 for me.
In this quarter, the U.S. Treasury Department has announced its intention to secure over $1 trillion in borrowing, a sum exceeding its prior estimate by $250 billion. Given the current condition of bond markets, the government is faced with the necessity of offering elevated interest rates to attract investors. Consequently, this situation could lead to a rapid escalation in expenses. Specifically, the country's budget deficit is at risk of swelling due to the cost of higher interest payments. This concern has even been highlighted by credit rating agencies, such as when they recently downgraded the U.S. long-term credit rating, partly citing the impact of increased interest costs.
If rates become unanchored from inflation, economic growth, or anything else, it says there's a structural problem in the market. We know there's massive structural problems in the lending markets because there's too much debt. And if you lose control, the Federal Reserve can't allow loss of control. I mean, don't forget, they're just being downgraded because of the shitty mess that the US is in because of its political impasses and everything else. Is if they lose control of the bond market, that's the world's anchoring asset. This should not be allowed to happen. So in which case, they will come in and stop it. And we saw that in March of 2020. They did the same where rates got ridiculous on the other side, going down, just completely, all liquidity dried up and the market broke. We have a risk that we could break the market again here. And in which case they will step in and say, we'll have to increase quantitative easing and buy bonds. But you could do it at a fixed price and say, we'll buy all bonds at 4.25% or whatever the number is, that they say, look, enough's enough. We know that the regional banks have problems with their bond positions. And if bond yields keep rising, they keep losing money. That makes them illiquid. And with high rates, there's money moving from deposit accounts in banks that are only paying 0.5% and moving to money market funds that are paying 5%. So they're losing their deposits and they've got losses here. Every time you take a deposit out, you have to kind of unwind some of the trades, but they're all down. So there's a huge, massive mark-to-market loss that goes on. And they're having to borrow money from the Fed to fund that right now. So in this financing facility that the Fed set up. Also, if the bond market breaks, it means that there is not enough participation from the key participants, banks, asset managers, market makers, to keep market liquidity. So prices start gapping around, setting interest rates which were not the intention of the Federal Reserve. And if they're setting interest rates that were not the intention of the Federal Reserve in a very meaningful way, then it can create problems. So it is very risky here, what happens to the bond market. So people need to keep an eye on it. The equity market might not like it either. Even the crypto markets may not like it if yields go up, because that puts pressure on everybody on their borrowing costs. Now, most mortgages in the United States are longer duration, but we've seen credit card financing rise. We've seen car leases rise. We've seen all forms of short-term financing rising. Corporations rolling over debt if they've got short-term debt, that's going up. And the US government themselves need to fund their bloody debt, right? And they're rolling over all of this debt. And the last thing they want to do is try and roll out 10-year debt at 4.5%, when the last time they were paying the interest on it, it was 1.5%. Suddenly you triple your interest payments, and then you have to borrow more money to have the interest payments because the taxation rate's low. We've got some dangerous dynamics here, which is why they need to cut rates. You could see that the end game of the debt, and in fact, I've done some videos called the end game, make it impossible to deal with. Now, most people think there's a debt default. I don't think there is a debt default. I just think that the use of central bank balance sheet goes exponential, which increases the cost of assets, but nobody's wages go up. It's like a mutualization of these interest payments across the general population without raising taxes. It's the same thing. But
and by the way, the decline in purchasing power. And by the way, the decline in purchasing power in the currency.
Yeah. And that's a mutualization of losses amongst everybody. But rich people hold assets, so they're protected. The less well off have incomes. Their incomes don't go up as much as the assets, so they're poorer. So that's where we're getting this income disparity.
Bond strategists, despite the Federal Reserve's reluctance to consider rate cuts, anticipate a decrease in U.S. Treasury yields in the coming months. The consensus among these experts, as revealed in a Reuters survey, is that the 10-year yield will not revisit its previous cycle peak. Although yield predictions have been challenged recently by a resilient economy and the Fed's inflation focus, bond strategists from sell-side firms have largely maintained their expectations for yield declines. The median forecast for the 10-year Treasury note yield in the next 6 months is 3.6%, a slight upward revision from 3.5% in July. This contrasts with the current yield of 4.03% and the peak of 4.34% recorded in October of the previous year. While some analysts express hesitancy about steep yield drops, Most anticipate that the 10-year note yield will not reach its cycle high of 4.34% during this cycle. Market dynamics have also shifted interest rate futures, with the first predicted Fed rate cut moving from March to May 2024. The market is currently pricing in 6 rate cuts for the following year. However, not all agree with this perspective, as reducing inflation from 8% to 2% faces challenges due to a robust labor market. The conversation also raises questions about the interpretation of Raoul Pal's remark, "Something will break." We invite you to share their insights in the comments. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.